Welcome back. Now, East Africa's community's goal of harmonizing domestic taxes continues to face headwinds as member states are yet to agree on uniform tax rates. EAC Cabinet Secretary Adan Mohamed says elimination of anti-competitive taxes could be used to promote the region as a single investment destination.
Talks on harmonization of taxes was first mooted by the EAC Sectoral Council on Finance and Economic Affairs in May 2012 in Kampala, Uganda. The move paved a way for the regional finance ministers to meet and draft the EAC domestic tax harmonization policy that would give guidance on how the regional tax process should be carried out. However, failure by member states to agree on uniform tax rules and rates for the region has slowed down the process.
Barriers, my goodness, this is a long story. That one, you know, you've seen these games where you're trying to catch the rat. You keep banging them and they're not getting sorted. Double taxation, avoidance of double taxation, we need to address that on a SG in the Secretariat. And we must clarify everything that have to do with our customs, rules and regulations. Sanitary and phytosanitary protocols need to be cleaned up. We also need to address our rules of origin that is creating huge challenges at the border and making sure that our trucks get to sit.
The challenges that we have seen is goods that are manufactured within EAC states sometimes are not as competitive as we would have liked them to be because of some of these existing domestic taxes, and it's one of the biggest challenges.
The EAC domestic tax harmonization policy proposed introduction of EAC-wide minimum excise rates by type of goods and services with regular adjustments and periodic realignment to take into account inflation and exchange rate movements. According to the policy, harmonization of tax rates within the East African community is expected to take a progressive approach starting from excise and VAT, followed by income tax at a later stage. On VAT, the policy proposes adoption of a single positive standard rate in each partner state subject to an EAC-wide minimum. For example, Kenya's standard VAT rate is 16%, while Uganda, Tanzania, Rwanda and Burundi are at 18%. With regards to income tax, the policy proposes adoption of common rules for determining the tax base, introducing a minimum income tax rate for each category to prevent harmful tax competition. The process has been slow since some partner states are dissatisfied with the plan to harmonize VAT, income tax and excise duty, which are considered critical sources of revenue for member states. Experts say elimination of double taxation that has been cited as a major hindrance to fairness and investment will highly depend on commitment by partner states. Mohamed says elimination of non-tariff barriers and market distortions could undermine implementation of EAC Common Market Protocol and the EAC Monetary Union Protocol.
Monetary Union, which is one of the key pillars, also the third plank of our treaty, is at a very advanced stage. All the underlying rules and legislations have been passed and assented to by the heads of states. And we are at this stage looking where to house this monetary union, in which country, and that discussion is ongoing. And in not too distant future, the plan is to have one common central bank like you have in Europe, one currency, so that when you go from one country to the other, you don't have to worry about exchange rates and so on and so forth. That program is progressing very well, and we should be able to see that happening within the region.
Harmonization of taxes remain elusive as member states stick to their own rates. But according to some members of the EAC, harmonization of especially excise duty and VAT will achieve neutrality for investment and trade. Caroline Jenga for Prime Edition.